The diamond chart pattern, this is a pretty rare pattern that signals a potential reversal in the trend. And it's actually formed by a combination of 4 different trend lines, 2 converging trend lines, and that creates a symmetrical triangle. And then 2 more trend lines that form a broadening formation. So the diamond top is considered resistance and the bottom of it is considered support. So the overall appearance of it resembles a diamond shape, hence the name of it. And we can see this pattern in any time frame, intraday, long-term charts. It doesn't matter. It can appear at the top or the bottom of a trend, bullish or bearish reversal. So to better understand it, let's dive into its distinct characteristics. So here's 3 of them. Formation. There's 2 phases, the widening price range, that's the broadening formation, and then we have the contracting price range, whereas the diamond shape forms, and volume. Typically, it's going to decrease during the formation of the symmetrical triangle on the right, but it's going to increase during the broadening formation on the left. When we see an increase in volume, that may confirm the pattern's validity. And then a breakout, that occurs when price breaks out of one of the boundaries. The bullish reversal goes above the upper trend line, bearish goes below. And we may see an increase in volume to confirm if that breakout is valid, but expect higher volume afterwards to really confirm if it's a true break. And listen, like all chart patterns, they're not as cleanly formed as you would like them to be. So think more of the concept of the pattern, why it forms. That's what makes the difference. So how do we identify it? Well, the best way is to remember how it forms. So number 1, the broadening pattern on the left. The pattern starts as a broadening formation. That is a combination of higher highs and lower lows. So this is an increase in market volatility. So then we get the symmetrical triangle on the right. The broadening pattern is followed by the symmetrical triangle. And this is where we're going to see lower highs and higher lows. So this indicates that the market is starting to form a consolidation pattern. It's the exact opposite of the left side. We have 2 converging trend lines. So the pattern is defined by those 2 converging trend lines. It connects the higher highs and the lower lows. These lines form a diamond shape, and that's how we get its name. Then we get horizontal support or resistance lines. So the pattern is completed when price breaks through a support or resistance zone formed within the symmetrical triangle. This breakout can be a potential trend reversal. So remember, key point, it does not have to be a perfect pattern. All we are seeing is an increase in volatility on the left and then a consolidation on the right. Eventually, this pattern ends with what? Just a symmetrical triangle breakout. That's it. So we need some strategies, and it's not a difficult pattern to spot. And when you do, you need a strategy to capitalize on it. So let's cover some simple ways to set our entry points, our stop loss, and some targets. So at its core, even with this interesting name, all we're trading is a breakout from a consolidation pattern. Let's not confuse it. So here's a step-by-step guide. Identify the diamond chart pattern. So as we talked about earlier, we look for the key components, the broadening formation, a symmetrical triangle, and converging trend lines, horizontal support or resistance line. We look for a confirmed breakout, and that's price going through a support or resistance line. It's crucial. We need that to happen. We can wait for price to close above the trend line for a bullish trade or below the horizontal line. That's going to confirm the breakout to the downside. Then we enter the trade. So once we confirm the breakout using whatever tools, we enter a trade in the direction of the breakout. Here's a long trade example. It's pretty simple. So the entry points, the ideal one is shortly after the confirmed breakout. So this ensures the pattern's been validated, the potential trend reversal is underway. It's important to note that the breakout should be accompanied by increased trading volume, but not always. What we want to see after a breakout is continued volume coming into the instrument. Now, I've seen breakouts on high volume, they collapse the next bar. So monitor the volume, if that's part of your strategy using volume, and look to see an increase, especially after the breakout, to confirm there's actual interest in the new direction. So proper risk management, we got to set a stop loss. And how did we do that? Well, for the bullish diamond formation, stop loss goes below the recent swing low within the pattern, or a horizontal support line. Just give enough room for that trade to breathe. A bearish one, place a stop loss above the recent high within the pattern or a horizontal resistance line. Targets, setting profit targets involves measuring the height of the pattern and using that measurement to project the potential price move. So here's how to set those. The bullish pattern, we measure the height of the pattern from the highest high to the lowest low. Now some will measure to the support line that they see, add the distance to the breakout point. The bearish one, do the same thing, measure it and we project that from the breakout zone to the downside. But our ultimate price target, that's labeled here in D. Now, these targets are only estimates. You have to monitor the price during the advance or the decline as it heads towards your target price. When you implement these trading strategies, you can take advantage of this pattern. It's pretty highly reliable just because of the type of breakout we're looking at, consolidated breakout, and it can be a potential trend reversal as well. So let's compare it to some other patterns. Again, I've said it before, it's a consolidation breakout. After price forms the broadening formation on the left, which is showing volatility, the right side triangle shows the volatility decreasing. Now this pattern can be either bullish or bearish. It just depends on the direction of the breakout. And it's unique in its formation, but there are other patterns that you should be familiar with. The bear flag patterns, triangle chart patterns, double bottoms. Each of these patterns, these also have distinct characteristics that can help you identify trading opportunities. My favorite are flags. I like trading those. And now the flag and the triangle patterns, these are a form of consolidation, just like the diamond. The double bottom is more of a support holding or failing type of setup. So let's compare the diamond chart versus the head and shoulders. Now the head and shoulders, everyone's heard about it. It signals a trend reversal. 3 peaks, a higher peak in the head, which is the middle, between 2 lower peaks, which are called the shoulders. The neckline is a support level that connects the lows after the left and right shoulders. Now, both of these indicate potential trend reversals, okay, but they do have differences. The diamond pattern is a diamond shape. Head and shoulders looks like a head and shoulders. Now, the head and shoulders is not a consolidation break, okay, but it can be classified as a support holding or failing setup while price puts in a lower high on the right side. Also, the diamond pattern can be a bullish or bearish reversal. Head and shoulders, primarily bearish, while its bullish counterpart is the inverse head and shoulders. Now, the diamond chart pattern, like I said, it doesn't appear a whole lot. It's not a very common looking pattern. So consider looking at triangle chart patterns, the 2-bar reversal pattern, a reversal candlestick patterns like hammers, shooting stars, engulfing patterns that can help you. Island reversals. This is not a common one, but it's a powerful reversal pattern. It's like a gap before and after a candle. That indicates a strong shift in market sentiment. 3-bar reversal pattern, more complex reversal pattern, 3 consecutive bars. That's a potential change in the trend direction as well. But you know what? For most of you out there, pick 1 or 2 patterns that you really like, that you can really spot, that you're comfortable with, and use that. Become an expert at those patterns. Build your strategy around those. Don't always go looking for something different. There's some pros and cons with anything, right? Chart patterns can be subjective, which is why I mentioned understanding the concept of what we're looking at. That's more important. So here's the pros of it. It's rare, but it's pretty reliable. Volatility. And then we see lack of volatility. There's clear entry and exit points. You can use with various time frames, different markets. It's versatile, right? Stocks, Forex, commodities, current crypto can use it. It's a valuable tool that way. It can help you identify trend reversals, continuations. Now, of course, there's cons. It takes practice to identify it because it doesn't always look perfect. Consolidated breakouts, they fail. It's subjective, right? You may see the pattern. I may not see it. Your friend may see it. You may not see it. They're subjective. You do have to have some experience and skill to use these patterns effectively. And it's not going to work in all market conditions, just like anything else. So let's wrap this up. It's a pretty great pattern. And when you can find that pattern and the other ones we talked about and use smart ways to manage your risk, you can take advantage of changes in trends and improve your results. You really can. Like any other trading method though, or any pattern, consistency, being disciplined, and always learning are the key to be successful. That's the bottom line. So since we're talking about indicators, you can grab this free PDF called The Ultimate Guide to Price Pattern Trading. Everyone wants to talk about indicators, but you can do pretty well just having a few simple patterns up your sleeve. You can download the free guide. Link is to the left in the description below. Make sure you like this video. We'll talk to you soon.